Exchange traded funds. What are they? If you're asking yourself that question, then you've come to the right place. ETFs are a type of security that can be bought and sold on markets just like individual stocks can. So if you want to buy an ETF, the process is exactly the same as it would be to buy an individual stock. They have their own symbol to search for them and everything. There are many different ETFs. Some are used to track a stock index, such as the S&P 500, and some are used to track a specific sector of the stock market. Today, we're going to be focusing more on the ETFs that track a stock index. Once you gain more experience, you might want to look into some of the newer, fancier ETFs that track smaller sectors. But for a beginner, an index tracking ETF is probably the best way to go. Now, here's an example of one of my favorite ETFs, something I definitely hold, and it is called VOO, and it's from a company called Vanguard, and it's an ETF that tracks the S&P 500 stock index, which if you've listened to the news at all, financial news, you might have heard that term, the S&P 500 or Standard & Poor 500 index being the 500 of the largest U.S. companies by market capitalization. But for our purposes, we'll just say the 500 biggest U.S. companies. So here is a list of the top holdings of that particular ETF. So there's obviously some familiar names here: Apple, Microsoft, Amazon, etc. Now, these are the individual stocks that make up the ETF. So if you buy into this ETF, essentially you're buying all of these companies, and this is only the top few. There's 500 in total. So you're buying just a little piece of each of these companies. So you can see if you were to buy into this ETF, this data is a few weeks old, but it's approximately, you'd have 6% of that would be Apple, 5.46% of it would be Microsoft, and so on and so forth. So what's the catch? It seems like a good deal, right? You're buying 500 companies at once. It seems like a really good thing to do. It is. But as you can imagine, these companies managing these funds aren't doing it purely out of the kindness of their hearts. They are going to be making some money, so there are fees associated with these funds. But the very good news is, for the majority of major ETFs, the fees are incredibly low, especially compared to traditional investment instruments like mutual funds, which I made a ranty video about recently. The fees in mutual funds can be close to 2%, I would say. So, for example, the annual fee for the VOO fund, I call it VOO, I mentioned earlier, is 0.03%. So if you invested $100, you would be paying 3 cents a year in fees, which is basically nothing. You may ask yourself, how are these fees possibly so low? Well, as of me writing this, the fund is worth about $731 billion. So 0.03%, even though it's very small, works out to about $220 million a year. So they're doing okay. So why are we buying an ETF? Well, if you aren't an expert, using an ETF is generally your best and safest strategy for investing in the stock market. And to be honest, if you are an expert, it's probably the best and safest strategy for investing in the stock market as well. Index tracking ETFs typically outperform the vast majority of professional fund managers, and there's been a lot of research around that. ETFs are safer because you are investing in a large number of securities, like stocks, for example, would be a security instead of an individual one. And I'm going to give you an example of what's happening here, why an ETF is a safer strategy. So let's say you like Apple. So there's Tim Cook. He's very happy that you are interested in Apple, and you've decided that you're going to invest $100 in Apple stock. And Apple stock is currently $100 per share. This is just for example purposes. It's actually about 140 right now, but just to make the math simple. So you now own one share of Apple at $100 a share. Great. The next day, there's a keynote address and Tim Cook comes up and he announces that Apple is going to pivot their entire company into selling fidget spinners. The market doesn't react well to this news, and all of a sudden Apple shares tank to $0 per share. An extreme example, but maybe not unrealistic if Apple decided to focus on fidget spinners. And Tim Cook is very, very sad. But what happens to you as an investor? Well, if you had invested your $100 in Apple stock, you would have lost all $100 and wiped yourself out if that was all of your life savings. If you had invested $100 in the VU S&P 500 index tracking ETF, you would have lost $6.02 because it was 6.02% of your holdings, but you would still have the rest of your $100 investment. So you'd still be okay in the long run. Now, here's another example of how things can go the other way. So Tim Cook announces that the company is going to be selling fidget spinners now, and they just slap a Apple logo right there in the middle of it, and people love it. And it's not, maybe Apple could pull this off. So Apple shares go up to $200 per share. Everyone's buying Apple fidget spinners, like they're selling like hotcakes. Everything's great. Now, what happens in this scenario? Well, if you had invested your $100 in Apple stock, it would now be worth $200, and you would have made a $100 gain. If you invested $100 in the index tracking ETF, you would have gained just $6.02 on the Apple component of your holdings. So you kind of see how this is a double-edged sword. So individual stocks, there's more to be gained, but there's also a whole lot more to be lost. So investing in an index tracking ETF is generally a lower risk, lower return strategy, depending on the ETF you choose, of course. And investing in individual stocks is a higher return, higher risk strategy. For the vast majority of investors, especially those who are new to investing, an index tracking ETF is a much safer strategy in the long run. And it's an easy way for a new investor to diversify their portfolio. And that's a word you hear a lot when it comes to investing is diversification. Well, what's better than, the S&P 500 has 500 companies. That's a whole lot of diversification just through buying a single investing instrument. So it kind of does all the diversification for you right there. Now, why the S&P 500? Well, I mentioned earlier that I like the S&P 500, and here's the reason why. Going back to 1950, the green here are the years where the market, well, the S&P 500, which you could kind of call the market because it represents a big chunk of it, but just the S&P 500 has gone up generally much more than it's gone down, as you can see here. And year to date this year, this data is a couple weeks out of date. I think it's actually been a bad couple weeks, but it's still in the green for sure. So as you can see, even through a global pandemic, the stock market has gone up, but that's a whole other story for another day. The point is, if you're looking to retire, you can kind of clearly see here that if you hold on to S&P 500 long enough, you're going to probably be in very good shape if you're looking at the historical data. So which ETF should you choose? I've already mentioned the S&P 500. Of course, nothing I say can be construed as financial advice. That's just don't sue me. But there's some other examples here, and these are the stock tickers you can look up. But really you want to do your own research on the fees and what securities are actually included in these ETFs, because that's the most important thing. That's what you actually are owning. And you can add a ticker symbol for an ETF you're interested in the comments below, and I can comment on it or make a new video analyzing it if I find it especially interesting. So hopefully that clears a little bit up for you if you're new to investing, and hopefully inspires you to have a look at an ETF. And that's a really good way to dip your toes into beginning to invest your money on your own. Thank you.